Q1FY23 earnings conference call of Kalyan Jewellers India Limited. The call will start shortly. Request you to stay connected. Thank you. Ladies and gentlemen, good day and welcome to the Q1FY23 earnings conference call of Kalyan Jewellers India Limited. The call will start shortly. Request all participants to stay connected. Thank you. Ladies and gentlemen, good day and welcome to the Q1FY23 earnings conference call of Kalyan Jewellers India Limited. This conference call may contain forward-looking statements about the company which are based on the beliefs, opinions and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Rahul Agarwal from Strategic Growth Advisors. Thank you, and over to you, sir.
Thank you. Good afternoon, everyone, and thank you for joining us on the Kalyan Jewellers India Limited Q1FY23 earnings conference call. We have with us Mr. Ramesh Kalyan Raman, Executive Director, Mr. Swaminathan, CFO, Mr. Sanjay Mehrotra, Head of Strategy and Corporate Affairs, and Mr. Abraham George, Head of Investor Relations and Treasury. Mr. Sanjay Raghuraman, who is the CEO, is unable to join the call today due to some personal exigencies. I hope everyone got an opportunity to go through our financial results and investor presentation uploaded on the company's website and stock exchanges. We will begin the call with opening remarks from management, following which we will have the forum open for question and answer session. Before we start, I would like to point out that some statements made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the earnings presentation shared with you earlier. I would now like to invite Mr. Ramesh Kalyan Raman, Executive Director of Kalyan Jewellers India Limited, to give his opening remarks. Thank you, and over to you, sir.
Thank you, and good afternoon, everyone. The recently concluded quarter has been yet another positive one for Kalyan Jewellers, and we are witnessing continued robust momentum in both footfalls and revenue across all our markets in India and Middle East. We launched our first franchised showroom in Aurangabad during the recently concluded quarter, and as we speak, the store is performing as per our expectations. We are on track to launch the remaining pilot franchisee stores before the start of the festive season. We have built a meaningful pipeline of additional franchise stores on the back of very encouraging response from the potential franchisee partners. Given the robust pipeline of franchisee showrooms and stability in the operating model of the already launched showroom, we believe we can advance the launch of the next set of franchisee showrooms. In the Middle East, we continue to see strong momentum, driven largely by the overall economic recovery in the region and return of tourist traffic. We remain confident on the market and will be looking for calibrated expansion through the internal accrual from the region. Our online vertical Kalyan continues to show traction, and it will be embarking on the next phase of growth, starting with the launch of the first physical showroom before the start of the festive season. Mr. Vinod Rai has been formally appointed as the independent chairman by the board of directors with effect from July 1st, 2022. Before I pass on to our CFO, Swaminathan, who will take you through the financial highlights of the quarter, I would like to highlight about the remarkable transformation in the profitability of the business when compared to the pre-COVID period. Our consolidated PAT over the 4 trailing quarters has been approximately 380 crores compared to 140-150 crores achieved in the few years prior to COVID. Let me conclude by saying that we are confident about the current financial year. Our Q1 performance has been impressive, with a continued traction during the current quarter, along with the robust store expansion plans for the rest of the year. We are extremely excited about the revenue growth as well as the overall profitability of the business. Over to you, Swaminathan. Thank you.
Thank you, Ramesh. Good afternoon. We are really happy to be talking to you all after a great quarterly performance. For the recently concluded quarter, our company reported a consolidated revenue of 3,333 crores, a growth of over 104% compared to the corresponding quarter of the previous year. Consolidated EBITDA was 264 crores versus 69 crores in the corresponding quarter of the previous year, a growth of 283%. Consolidated PAT was rupees 108 crores versus a loss of 51 crores in the corresponding quarter of the previous year. Now let me give you the breakup of the Q1 performance, starting with India. For the recently concluded quarter, our India revenue was 2,719 crores versus 1,274 crores when compared with corresponding quarter of the previous year, a growth of 113%. Our India Q1 EBITDA was 218 crores versus 50 crores when compared with the corresponding quarter of the previous year, a growth of 336%. Our India PAT was 95 crores compared to a loss of 43 crores in the corresponding quarter of the previous year. Now let me share some information about our Middle East business. Our Middle East revenue for the quarter came in at 574 crores compared to 340 crores in the corresponding quarter of the previous year, a growth of 69%. Middle East EBITDA was 47 crores versus 18 crores over the same period of the previous year, a growth of 161%. Middle East profit came in at 14 crores for the quarter compared to a loss of 9 crores in the corresponding quarter of the previous year. Moving on to our e-commerce business, our e-commerce initiative Kalyan posted revenue of 44 crores versus 24 crores in the corresponding quarter of the previous year, a growth of 83%. The quarter recorded loss of 1.2 crores was a profit of 31 lakhs for the corresponding quarter of the previous year. Coming back to KJL, during the quarter, we had no bullion sale and our gold coin sale to retail and corporate customers was approximately 13 crores, which is approximately 0.46% of our total revenue. During the quarter, we opened 4 showrooms, including a... With this, I am done with the summary of financials and now open the floor for questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who would like to ask a question, please press star and 1 at this time. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Aniket Sethi from ICICI Securities. Please go ahead.
Hi Ramesh sir, good afternoon. Thanks for the opportunity. It's again nice to see the comment on good new consumer recruits in your presentation after it was skipped in the previous quarter. So 2 questions there. First part, wanted to understand, is this largely pertaining to the non-South market? Essentially what I'm also trying to understand is what would be the difference in contribution from new consumers or rather new customers in your South versus non-South markets on a same store level basis. The second part is, while I understand it's more of a secular trend, the new consumer recruits, but do some factors lead to acceleration in specific quarters?
Yeah, so the growth from new consumer has been very similar across both the markets, South and non-South. And the difference in overall growth rates is because of the impact of lockdown in the base period.
Okay, you mean the base period had some impact of lockdown and rather the sequential quarter, and that's why the gains from new consumer were lower. Is that what we are pertaining to?
Yeah. So this year we see more new consumers from non-South markets. Okay, that will be because of the lockdown impact.
Understood.
And also, because we are opening new stores basically in the non-South markets, the new customer growth will be more there.
Okay. And what the understanding is let's say, see, you would be gaining, or rather the share of new consumers from unorganized players would be higher, right? It's slightly difficult to gain share from the branded players. But given that thing is there, the gains from non-South markets should be higher from the South markets on a like-for-like basis. Is that understanding right?
No, can you repeat that question again?
South market, let's say from a industry perspective, the share of organized players is estimated to be higher in the South market versus the non-South markets.
Yeah.
And a lot of your new consumer recruits would be coming from the unorganized market as well, right? The share would be higher from those particular segments. That should be a key advantage for some of the new consumer recruits from your non-South markets in Delhi, Mumbai.
There are 2 things. First of all, even though in the organized segment, South is like more organized than non-South, yes. But we have still got a majority or a good quotient of non-South unorganized players in South also. So we are gaining market share from there. But when you come to non-South, yes, the unorganized to organized shift is more aggressive there because there is more vacuum from unorganized players. And again, we have opened new showrooms there last year in non-South markets, okay, and South markets. So we will get a new customer growth in in the stores which we opened last year, no?
Understood. Got it. Understood. That's helpful. Second, on the franchising bit, can you share some details on how are you selecting your franchising partners, the franchise partners? Are these the interested parties in the jewelry business, or you are looking mainly at financial investors?
Yeah, so we are not looking for franchisee partners to get involved in the day-to-day operations at all. Okay, so we don't give any preference in experience in the industry because of that. But we have a process put in place where it will be multi-stage background checks and thresholds for net worth, etc. And we have a consultant who does the job for us.
Okay. And till now, how many, let's say, is this like you're signed with a single franchisee and he's expanding your store, or it's more like every store is a different franchisee altogether?
It is different, which we have signed. So we have signed 6 LOIs, and we have not signed more than that now because we are just waiting for the first set of franchise to open and get operated. On the franchise which we have already opened in Aurangabad, it is performing like what we wanted.
Understood.
But we have a pipeline of other franchisee partners who are interested to work with us. We have put them on hold because we want to just get settled more with the existing franchise which is already there and what we are planning to open in the next couple of months.
And all the franchising is done in the non-south, right? Nothing in
everything is non-south. So not only franchise, all the stores planned for this financial year are in non-south. Almost all the stores.
Got it. On the OPEX bit, given expansion, you'll see some operating leverage. So if just on the ad spends, if you can just clarify. See, you had broadly 200 crores of India ad spends in FY20, the last normal year. So any guidance you have on the absolute numbers, given you don't look to enter any new cities, or we should continue to look at this number from a percentage of sales basis?
So we should. If you look at Q1, it was at 2.2%, but on a year level, I think we should be looking for a 2%. That's our target.
2% on a yearly. Okay, got it.
Yeah. So
got it.
1.8 to 2. So our target is 1.8, but keep it as 2.
Got it. If I can just squeeze one last question. On the jewelry hallmarking bit, any incremental updates you can share on how's the compliance, whether it has increased or same versus what it was some time back?
So they are keeping on fine-tuning the hallmarking procedure, wherein there was some loophole where 22 carat and 21, 22 and 19 were made compulsory hallmarking. So people used that gap wherein the 20 carat etc. were sold without hallmarking. Okay, so that gap is also being solved now. So a couple of months before that is also solved. So they are tightening the process, and we expect that further there will be strengthening stringent processes etc. And next 12 months, I think it will be fully set. That's what we feel, because with the increase in duty, surely government will also understand that should be also tightened, no? So there will be more incentive to actually tighten the process.
Got it. Perfectly understand. Thank you so much, Ramesh. Wish you all the best.
Thank you.
Thank you. The next question is from the line of Shirish Padeshi from Centrum Broking. Please go ahead.
Yeah, hi Ramesh and team. Thanks for the opportunity and congratulations for good.
Thank you. Hi.
So I have 3 questions. The first question which comes to my mind, that Candere has been growing much faster, but surprisingly, you have booked the losses of about 12 million in this quarter. So if you can quantify what is it exactly, is that OPEX is going up and because of that this is in nature, or it's one time we have taken some correction?
So Candere, as you rightly said, it has been growing in the range of 80% year on year, right from when we acquired it. And Now we are looking for the next set of or the next phase of expansion, where we have already started investing in upgrading the software, upgrading the team, aggressive marketing spends, etc. Because we are gearing to the next phase of expansion. As I told you, we are planning to open the first physical showroom before Diwali this year, and we are looking forward for that.
Okay. So this store again will be in non-south market, or it will be in metros?
Yeah, it's in Mumbai.
Okay. My second question on slide 36, when I see, it's heartening to know that the non-south revenue has moved up from 30% to 34%. I think directionally it is picking up. But I was a bit surprised that studded has not moved in that ratio. I mean, studded has moved from 20% to 24% in this quarter. So any thoughts how you look at the rest of the year for non-south revenue and the studded portion to move up?
Yeah, so if you look at Q4 versus Q1, okay, so Q4 versus Q1, the studded ratio is almost stable, wherein it is around 24%. Even though actually Q4, the non-south revenue mix was higher than Q1, okay. But of course, we know that year-on-year is not a right comparison because of the disruption. And the thing which you are seeing is year-on-year, wherein the markets were completely uneven, the opening, the closing, etc., due to the disruption of COVID. So if you look at quarter-on-quarter, it is more or less stable at 24%.
Yeah, I got that, Ramesh. My only point, what I was trying to say that we put a lot of energy to get our studded portion up and even non-south. So what is it that we can expect in the balance of year?
Okay, so we have constant push to increase the studded share, and the studded share will be higher mostly in the non-south markets. And usually Q3 and Q4 are more non-south heavy, okay, and Q1 and Q2 are south heavy. So if you look at Q3 and Q4 should do more studded in a usual scenario. And again, all the new stores which we are opening in the non-south markets, which is going to take your studded ratio higher, and subsequently margins will also be higher.
Okay,
that's our target.
Okay. In the domestic business, the growth is superb. But if you can say that how much was the grammage growth, that would be really helpful.
Grammage is almost stable, Q4 to Q1.
No, what is that number?
Okay, I'll just give it to you, okay, in kilograms. You can go forward. I will come back to you and give the number.
Yeah. My last question is on, of course, we have seen the gold metal loan is one of the things which is impacting. And we have seen that the cost is also coming down. But margin has not moved. I mean, we are still at 7.9 with the recovery which has happened. I think maybe after 5-6 quarters, we have seen a normalized quarter, and we had good season also. I'm sure in the second half, season will be much more better, sharper. But what is it that at this time we can expect 8.5-9% EBITDA?
So here, first of all, 8% EBITDA in Q1. Q1 is a more south-heavy quarter. Q2 will also, we think that it will be in the similar lines. But Q3 and Q4, we estimate to have a better EBITDA margins than Q1 and Q2. And to your question, where it will reach 9%, as we have told before, once the non-south revenue mix increases, the gross margin will increase and the EBITDA margins will also go up. So if you look at our expansion will be focused in the non-south markets, and that is where, or that is the direction where we are going to go also.
Okay. The last question, you did say in the beginning that we have opened the Aurangabad store. Yeah. And you did say that there are some more stores which will come in the franchise-owned company-operated model.
Yeah.
So if you can tell some timelines, whether this will be before the season, next season, or it will be during the season or post quarter 3, quarter 4?
The pilot franchise stores, we had planned for 6 numbers.
Correct.
Now, 1 is already done. Rest 5 will be done before Diwali.
Okay, before Diwali. And can you share a month's experience? What is it that you have experienced in Aurangabad?
It is, meaning, regarding the store success, there is no challenge at all because we have been expanding over new markets for the past many years. So the only area was to fit in the working, dimensions where it is well on track. It is now more than a month now, and the operating model which we had set has got stabilized.
So my question was, let me redesign the question. Is it more of a yellow metal demand which is happening because that's a tier 2 market, we can say that? Or what is the local consumption pattern? Is it pure gold, it's a studded gold, or it is purely a studded?
No, so studded ratio usually outside South India is more than 30%. Okay. But in tier 2 in South India, it is in the range of 21 to 22%. So this being a non-metro and a tier 2 market, it is in between the South and the usual non-South percentage. So it is, in short, it is between 22 and 30.
Okay.
But that was estimated as well.
Okay. All right. Thank you.
Yeah. And regarding the volume,
yeah,
it was 4,000 kg. And
4,000.
Just for you to understand, we actually try maximum to increase our studded ratio. So we, as a brand, more than volume, of course, we target on our revenue, and also we try to push to the studded where we do not focus on more of a gold volume. We focus on revenue growth because we also, as a brand, push studded jewelry.
Okay. Wonderful. Thank you, Ramesh, and all the best to you and the team.
Thank you.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question at this time. The next question is from the line of Nilay Shah from Moon Capital. Please go ahead.
Thank you. Sir, I have a few questions. The first one is just if you can qualitatively talk about how the trend is panning out in July and maybe starting of August. Without getting into numbers, that will be helpful.
Hi, Ramesh. So, July, as we speak, the momentum is very good. It is actually the footfalls, the momentum, the consumer sentiment, etc. are extremely positive. And in Middle East also, the trend is being very positive as we speak. And we expect a good season.
Okay, that's good to know. The second bit is on the interest cost. Now, given that our metal gold loan component is moving up, which you highlighted last quarter, and will that more than offset any interest cost increase that you will see because of the environment at this point in time? Which is to say that on a sequential basis year on, should we be expecting a marginal drop in interest cost for the company every quarter?
Yeah, so if you look at, there has been some interest hike in the recent past for the non-gold loan quotient, okay, in Q1. And we should also expect that there is some hike in the interest rates. But, of course, as you rightly said, we were at 1,500 crore gold loan in the last financial year, which is now at 1,600. And as we speak, it is 1,650. Okay. And that will negate most of the cost increase because of the rent. And we can expect a minimal reduction in interest because there is a interest cost hike which is happening now when compared to last.
Yeah, so it will offset that interest rate hike is what I wanted to know. Yeah, so that's good to know. Okay.
You should gain some also.
Got it. Moving on to the balance sheet, your P&L seems to be on track. You've delivered last few quarters of strong growth, and the margins also seem to be seen on track. So if you just can talk a little bit about the ROE profile of the company, Strictly on the basis of calculation, annualized, it's about 12% at this point in time. But if I was to, let's say, remove off some of the fixed assets which are probably being used for collateral against your gold metal loan, you are clocking ROEs of about 14% or so, and ROCs which are probably in the ballpark of 14 to 16%. Does this mean that at the store operating level, the ROEs ex franchising would be upwards of 20%?
Okay, so I will answer what you call part by part, where yes, ROE is now at 12%, and yes, there are collateral which has been mortgaged in banks for our exposure, which is a traditional way of getting bank loans in our country, especially in our sector. When we move on to franchise, where our own store expansion is lesser than the franchise, and we have more liquidity in the system in terms of reduction of own store expansion. When we go and reduce the bank loans, these collateral will come out, and it will surely help us to have some free cash, which will again increase our ROE.
Got it. But can you confirm whether at the store level today, you are running with ROEs which are in excess of 20%?
Yes, correct.
Okay, got it, sir. That's it from my end. Thank you very much.
Thank you.
Thank you. The next question is from the line of Pankaj Bobade from Affluent Assets. Please go ahead.
Thanks for taking my question. Am I audible? Hello.
Yeah, very much.
Well, so congrats on a very good set of numbers. Just wanted to understand, given that this is like-to-like comparison for same period last quarter would not be a right one. The thing is that whether this momentum of, say, approximately 3% PAT margin is sustainable going forward, or do we see anything, it coming down at some lower level?
No, so Q1, if you look at Q1 has been very good, and if you look at our 4 quarters, because why I'm telling 4 quarters is because we have got disrupted 4 quarters together post-COVID for the first time. So if you look at the PAT number there, it is 380 crore plus, okay, which is like 2.5x when compared to our FY 2020 PAT, okay. So EBITDA margins are at 8%. Gross margins are getting stabilized at around 15.5%. And Q3 and Q4 are better EBITDA margins because better gross margins. So I think it should be more than sustainable.
So my second question would be, in one of the last call you had mentioned that with the franchisee business model coming into play, our margins would expand. Can you please throw more light on the same? How would it happen?
Yeah, so margins will expand at the PBT level, meaning not on the EBITDA level. Because as you know, franchisee, the EBITDA margins will come down because we are not going to get the whole gross margin to our books. But because it's a FOCO model, at the GP level and the EBITDA level, it will be lesser. But on a PBT level, it will expand.
But as you mentioned in previous participants' answer, that you are looking for an investor who would not be in day-to-day, who would not be interfering in day-to-day operations of that specific franchisee.
Yes.
So how means he would be just investing in the location, the property, right? So
they will be investing in the inventory and the capex, and we will be managing the store for them. and it's a gross margin share where the OPEX will be borne by them except the salary cost.
OPEX would be
The
drawn
PBT
by
levels
them,
in short, the PBT levels will be same or more than the PBT levels now for the existing stores.
Okay. Sure. Thank you. Thanks a lot.
Thank you. Anyone who would like to ask a question, you may press star and one. The next question is from the line of Deepak Poddar from Sapphire Capital. Please go ahead.
Yeah, thank you very much, sir, for the opportunity. So I just wanted to understand, first up, number of stores we are looking to open both on the own side as well as the franchisee side in FY23.
Yeah. So if you look at our expansion, it is going on track. We already opened 4 showrooms in Q1, out of which 3 are in the North-South, out of which 1 is franchise. We are getting very good response from the franchisee partners. So there might be a change in the composition between the franchise and own store. The expansion plans are on target. We will see how it gets stabilized, and then we will come back to you on the exact composition between franchise and own store. As we speak, the plan is to have 12 own stores and 6 franchisee stores for this year.
Okay, so total 18, and this composition is subject to change, maybe on the interest or how the franchisee are performing, right?
So as you know, franchise, we don't want to lose the opportunity of the prospective franchisee coming on board. Mm-hmm. There might be a chance in composition between franchise and own store. It will depend upon the stability at first, and the first store is already stabilized. But we are waiting for the next set of showrooms also to get opened and then decide on whether to change the composition or not. But even if it happens, it is good because, as you know, PBT levels it's the same, and we might have to convert a few of our own stores which is planned to the franchisee people, but it will be only delay by a quarter or by a couple of months.
Okay. So fair enough. That I understand. And you did mention that PBT level is same for own versus franchisee store, right?
Yeah. Maybe better also.
Okay. And for own store, what's the capex per store generally on an average?
So there are own store, it is 30 crore on inventory and 4 to 5 crore on capex.
Uh-huh.
Franchisee usual bucket is 20 crore on inventory and 3 to 4 crore or 2 to 3 crore on capex. But there are franchisee partners who come for a bigger bucket size also. So that only then we will be able to convert our own store to franchise, right? Because if they come with a 20 crore for a 30 crore store, it cannot happen.
Correct. But in case of franchisee, that the capex of 3 to 4 crores as well as the 20 crores inventory is being funded by them, right? Ideally.
Yes, correct.
So ideally, for us it would be only 12 stores into 35 crores, right? That's the rough cash flow.
Initial plan is that, and as I mentioned before, it will depend upon the franchisee again. The next set of franchisee getting stabilized. Correct.
And so my last query is on your revenue growth. Largely, I think this first quarter was a low base last year, right? So ideally, a 20% revenue growth seems little conservative given the fantastic performance we have delivered this quarter, right? So just wanted to understand the same from you.
Yeah. So yes, as you rightly said, according to us, Q1 has been good. Q2 momentum and traction, as we speak, continues to be extremely strong, both in India and Middle East.
Uh-huh.
With respect to showroom launches for the year, we have already opened 4 stores. Already announced 10 more stores before Diwali, and also we are going to get the full year impact of the 18 stores which we opened last financial year.
Correct.
And as I mentioned, we launched our first franchise. It is just getting stabilized. It is almost stabilized. It is again going to give a additional capital efficient leg of showroom expansion. All put together, yes, we are extremely excited about the current year revenue and the way forward.
Right. So there's an upside risk to this 20% growth that we have been seeing, right, on FY23 on an overall basis on a revenue growth. Because as I see, a 25-30% revenue growth is quite possible for us.
Yes, we don't want to give any perfect guidance on the number, but I gave you an overview, right? So we will not be able to give a perfect guidance because you have got the message what I meant. Right?
Yeah, fair enough. Yeah, that's quite helpful, sir. Yeah, that's it from my side. All the very best. Thank you.
Thank you.
Thank you. Anyone who would like to ask a question, you may press star and 1. The next question is from the line of Pallavi Deshpande from Smart Car. Please go ahead.
Yes, my question has been answered. Thank you.
Thank you.
Thank you.
The next question is from the line of Hemant, an individual investor. Please go ahead.
Well, congratulations on a very good set of numbers. I have a couple of questions.
Thank you.
First of all, I would like to know, you are targeting almost all the franchisee stores to get opened in non-South. So, is there any particular reason behind it?
Yeah, so non-South, as you know, gives us a better gross margin. The gross margin gap between South and non-South is in the range of 8 to 10%. That is one reason.
8 to 10.
Second is that we are very well penetrated in the South. We are there in almost all the Tier 1, Tier 2 cities. We are not very well penetrated outside South India. We have a lot of vacant markets there. That is why we are planning only for non-South markets.
Okay, sir. But my second question is, any kind of revenue target you have in mind, like the previous participant asked, I think you can do more than 20% revenue growth. So any ballpark number, maybe a range?
Unfortunately, you know our limitation. We will not be able to give any guidance. But on the whole, you would have got what exactly drives us this year and what plans we have and what has happened in Q1 and at present what is the status. So we are very excited.
Sorry, even if you can't provide a specific number, maybe a range will help actually, sir.
No. That is, we will not. I'm very sorry.
Okay. Not a problem, sir. But one more question from my side. It may sound actually weird, but I would like to know, any spurt in the gold prices, how does it affect the company? On the one hand, there is an inventory gain, and on the second hand, there may be a slow in demand. So how does it impact you overall?
No, on a consumer side, as you know, consumers have seen gold price going up, coming down. The fluctuations are already seen, and consumers exactly know that gold is a long-term asset and a very liquid asset. And as you know, gold here is not only seen as an investment, but also as a part of custom and ritual. So on a consumer point of view, there is no impact. And consumer comes with a budget. If the gold price is very high, the volume which he is going to buy, he or she, will be lesser. If the gold price is low, then the volume which he or she is going to buy will be higher. But the budget is not going to vary. So there is no impact or zero impact for a consumer point of view. For the company, we don't take any price risk or price gain on our inventory.
Okay, sir. Thanks a lot.
Thank you.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. The next question is from the line of Pratmesh Agarwal from Varanium Capital. Please go ahead.
So congratulations on a very good set of numbers. I had just one query. So what is the guidance on the not a fixed number, but a ballpark average rate that we want to maintain in the ads and promotional expenses?
Yeah, so Q1 we had a 2.2% of our revenue was spent for ad and promotion, and it depends. It varies quarter to quarter. So plan is to restrict it between 1.8 to 2%.
Okay. So we want to maintain it as a percentage rather than an absolute, right?
Yeah. Because we will need to do
Hello.
that, wherein if you have at different stages, you will have to invest in marketing depending upon the revenue and the revenue contribution from different regions or a market or a particular town.
Okay. Okay. Thanks a lot. That's it.
Thank you. Anyone who would like to ask a question, you may press star and 1. Ladies and gentlemen, you may press star and 1 to ask a question at this time. The next question is from the line of Vaibhav Kokate from Ashmore Group. Please go ahead.
Hi, thanks. Could you explain seasonality in this business?
Yeah, so seasonality, Q1 and Q2 are more of south heavy. Q1 comes with Akshaya Tritiya, and Q3 and Q4 are more non-south heavy. Q3 starts with Dhanteras and then Diwali and the wedding season. So if you look at quarter-wise, Q3 usually is the best quarter. Second comes Q1, third comes Q2, and last comes Q4. A usual scenario.
Got it.
Q2 and Q4 used to be similar.
Thank you.
Thank you. The next question is from the line of Chetan Shah from Jeet Capital. Please go ahead.
Yeah, hi. Thank you for an opportunity. Just one small quick question. This is specific to our franchisee business model. If I've been understood this correctly, we are kind of experimenting in a particular region, maybe non-south area, and see how this is evolving. So if you can give us some flavor that in next 2 to 3 year time frame, how do you want to take this forward, and what are the 2 or 3 important parameters you will be tracking to take this on a fast track going forward? That will be very helpful from your side, please.
So if you look at as of now, we already have signed 6 LOIs. Okay, we opened 1 store, and that is getting stabilized. Stabilized in the way it is, the operating model is stabilized. Otherwise, store opening or revenue at a store or walk-ins, that is not what I mean, because that is all a usual scenario wherein we usually open 18-20 stores a year. So this particularly because it's a new operating model, that is why we highlighted that it has got stabilized, and our plan is to go aggressive on expansion through this model. But why we are holding it on now is just for the pilot franchise stores, which is the 6 franchise stores which we want to open. We want to exactly understand whether the stability is there in the operating model, so that then we can accelerate the plan and go aggressive on expansion plan through this new window. And for our understanding, there is a good pipeline of franchisee people who are interested, and we have put them on hold because we want these stores to get stabilized. But I will be able to give you more clarity on the progress by the end of this quarter.
Sure. That will be very helpful. Thank you. That's it from my side, sir. All the best, please.
Thank you. Anyone who would like to ask a question, you may press star and 1. The next question is from the line of Pankaj Bobade from Affluent Assets. Please go ahead.
Thanks for giving me another opportunity. So first thing I would like to ask you is, what is our target ROE going forward as our franchisee business model stabilizes? So where do we want to take it from around 12 to 14% to what level?
Yeah, so all our new showrooms, the ROE is around 20%. So the more new showroom comes, then it will get averaged from the 12 which is there today. And in between, as I told before, we have plans to meaning once the franchisee gets stabilized and once we go very aggressive on the franchisee expansion, once we don't use the full cash flow which comes for store expansion, there will be reduction in our bank exposure, which will take out certain securities, which again comes in as cash excess to the company, which will again further improve our ROEs. So that is our target.
So how many of our stores are so-called old stores which are contributing less to the ROE?
We have meaning only one store is franchise, rest everything is owned.
No. You mentioned that we have 158 stores right now. The new stores are contributing 20 plus. The old one, which are contributing less, I just wanted to have a rough approximate number. How many are those?
No, not. I didn't mean like that, because why I told 20 is because the overhead expenses are borne by the existing stores. So the corporate overheads are not increasing when we increase the number of stores. That is why we are highlighting that new stores are 20% ROE and operating leverage will start stepping in. So, did I make it clear?
Yeah, I got your point. I just wanted to have a rough number. Okay, how many are the new ones which have started, which are contributing better?
No, all the new stores are contributing how we needed, because of course the revenue which we estimate from a store gets achieved. So it is not that one particular store contributes more.
Okay, my second question is that we have a battery of celebrities for endorsement. I mean, for advertisement. So our A&P is relatively quite a high number, which is in a normal thing in jewelry business. But I have seen in some parts of, especially Central India, where the local stores are using their own customers as sort of celebrities to advertise. So have you looked at this angle, which maybe probably reduce your A&P? I don't know, maybe it may even dilute, but I just wanted to request you to have a look at that thing. Hello?
So I understood your question. So in marketing, if you see, Kalyan as a brand, we are able to scale up throughout the country, which is very rare in the jewelry segment. Right. We started from south and we are able to penetrate into almost all the parts of this country, and that is because of the strength of the brand which we have created over the past many years. And we are well stabilized with our existing model for marketing and brand promotion. And the percentage of marketing expense which we do is in very similar lines with the industry standard. It is in the range of 2.2% is what the industry spends. It is more than that, in fact. So, to answer you, whether we can use our consumers for marketing, we still do that on a micro level. But that cannot in any way substitute the macro level marketing which we do.
Okay, got your point. That's all from my side.
Thank you. The next question is from the line of Deepak Poddar from Sapphire Capital. Please go ahead.
Yeah, thanks once again, sir, for the opportunity. Sir, I just wanted to understand on the debt side, how do we see debt build up going forward? Yeah, our gross debt level is 3,364 crores. It's very similar to March. Sorry to interrupt, sir, but your voice is not quite audible. Yeah, our gross debt level. Our gross debt level is same as March numbers, which is 3,365 crores, and this will be stable as we go and complete this year. But if I see interest cost, it's been declining since last 3 quarters. I presume it might be because of the change in mix of your gold versus your normal loan, right?
Yeah, it is.
Okay. So current interest cost of 75 crores, is that the range we are looking at? I mean, in spite of this higher interest hike
So the number which you are saying, it includes lease interest, which is Ind AS numbers. If you look at our financial cost, that is bank interest, it will be around 50 crores per quarter.
and that's likely to remain stable, right? I mean, in spite of that rate hike.
Yeah. So if you look at our interest, as I mentioned before, you can expect that it can be marginally lesser than the last financial year, because the gold metal loan quotient is increasing when compared to last year. Even though the interest cost, there is an increase by the banks, that will be negated because of the gold loan quotient, which we are increasing. So when compared to the last year, you can expect a marginal decrease in the total interest bucket.
Net, after the impact of these two.
After the impact, yeah.
Okay, fair enough, I understood. Yep, that's it from me. Thank you very much. All the best.
Thank you. The next question is from the line of Prathamesh Agarwal from Kalyan Capital. Please go ahead.
Thanks for the opportunity again. Sir, just one question. So since we are saying that second half will be north heavy, so what can we achieve like 16.5, 17 kinds of level in the second half from a gross margin perspective? Like we've also previously stated in calls that whenever the studded mix ratio tends to move around 27-28%, we normally tend to make margins in that range. So would the exit for the year could come, around 16.5, 17%, if all things remain, same?
If you see the studded ratio before pre-COVID, when even the studded ratio was 24%, we used to achieve a margin between 16 to 17. If the south non-south revenue mix is 35-65, but now because of the new studded products which we have launched, wherein the gold content is high, the 24% studded ratio is actually, it should have been 27% to get the same 16-17% margin. Last year Q3 was 16% margin.
Okay, so you're saying in a sense that because of the newer product mix, I think we'll have to make that mix 27 to kind of achieve a 16.5 kind of margin.
If studded mix goes in the range of 26-27, then the margins will be in the range of 16 to 17.
Okay. Do we expect that kind of level by at least quarter 4, or till that time we'll have clarity on non-south stores, franchisee stores, as well as since the entire store opening for this year is in non-south markets?
So the focus is on non-south markets. Studded ratio usually is very high there. So and Q3, Q4 are more non-south heavy. Studded ratio should grow because of that. And last Q3 the margins were 16%, and our focus is also to grow the non-south revenue.
Okay, so that's it. Thank you.
Thank you. The next question is from the line of Prashant, an individual investor. Please go ahead.
Hello, am I audible?
Yes, sir, you are audible.
Yeah, sir, congratulations on a good set of numbers. Most of my questions have been answered. Just 2 financial questions. For this quarter, what has been the cash flow from operations before tax? Hello?
Yeah, please. Can you repeat the question?
What is the cash flow from operations before tax on a consolidated basis?
Okay, just give me a moment. I'll just tell you the figure. You can go to the next question.
Okay, and my next question is on the advertising and promotion expenses. It has been explained that we are very much in line with the industry. But as we so the other way to look at it is that as we grow in the top line, do we still keep the same percentage, or I mean the absolute number will be same, so the percentage will kind of taper down?
No, we will surely bring down the percentage. That's why from 2.2, then our target is 1.8 to 2%. It will be further brought down when the top line grows. So it is not that consistently we will be spending 2%.
Okay. And on the cash flow side, sir?
1 second.
Yeah, our cash flow is for the quarter is about 190 crores.
190 crores. So I guess the build-up in inventory has been used to because if we see the profit before tax is around 400 crores at depreciation, and so I think there
quarter or the full year, sir?
Quarter.
Okay.
So, is there a build-up in inventory in anticipation of business in the coming quarters?
So this, you have to understand, as the season comes in or new shops being opened, there will be a continuous movement in inventory, which will be requiring build-up of inventory.
Okay, that's it from my side, and wish you all the best for the coming quarters.
Thank you. Ladies and gentlemen, due to time constraints, that was the last question for today. I now hand the conference over to Mr. Ramesh Kalyan, Executive Director, for closing comments.
Thank you. So, thank you very much for participating in the earnings call, and we really look forward for a fantastic year ahead and starting from Q2. So Q1 we are really excited, and way forward also we are really excited. Thank you very much, and see you also. Thank you.
Thank you. On behalf of Kalyan Jewellers India Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.